Welcome back, everyone, to today's deep dive into a really striking trend across the US housing market, the wave of collapsing rents hitting certain cities in 2025 and what that means for landlords, renters, and the broader economy. We'll look at what's driving the drop, which cities are most affected, and how both tenants and property owners should think about what's coming next. Let's begin with the broad picture. For years after the pandemic, rental prices in many US metro areas raced upward, but in 2025 the narrative shifted. Median asking rents across the 50 largest metropolitan areas fell by around 2.2% year over year for 002 bedroom units. Realtor Plus One. The national median asking rent is still higher than it was pre-pandemic, but what stands out is the downward trend. Rents are no longer relentlessly rising. That matters for renters hoping for relief, for landlords expecting steady cash flow, and for investors watching market signals. Why are rents falling in some places? A handful of key drivers are emerging. First, oversupply. In some markets, an explosion of new multi-family construction pushed available units higher than demand could absorb. For example, in the metro of Austin, Texas, vacancy rates for two-bedroom apartments climbed to nearly 9.92% in April 2025, from just under 4% in September 2021. TeamPrice.com, that surplus of units gave renters more choice, and landlords began competing, trimming rents and offering incentives. Second, shifting demand. Post-pandemic moves, remote work lifestyles, changing migration patterns, and economic headwinds such as high interest rates, inflation, job uncertainty meant some of the dramatic rental demand growth of 2020-22 cooled. In places that boomed early, the correction is sharper. Third, regulatory and policy shifts. Some cities loosened zoning, expedited permitting, encouraged higher density developments which increased supply and brought down asking rents. For example, in Providence, Rhode Island, streamlined permitting and repurposing of existing structures are credited with rent drops. Reason.com plus 1/4 the broader economy. Landlords face higher costs, interest and financing rates are elevated, property taxes may be up, and while rents may drop, operating costs do not always drop as fast. That puts pressure on yields and forces strategy changes. Now let's look city by city. While we cannot reliably list a full top 10 without perfect data for all markets, we will highlight key metros that are emblematic of the rent collapse trends in 2025. First is Austin, Texas. This city led the pack in rent declines among major US metros. According to a recent study by Redfin, Austin's median asking rent dropped about 8.8% year over year to roughly $1,385 in May 2025. Spectrum Local News plus one. Another source shows a drop of around 17% for two-bedroom multi-family apartments between August 2022 and April 2025, from 1,326 down to 1,431 in the Austin Round Rock region, driven by vacancy rising from 3.6% to 9.92%. TeamPrice.com. What lessons emerge from Austin? A rapid build-out of new apartments. The metro approved about 64.5 multifamily units per 10,000 people between April 2024 and March 2025. House of Leon. Supply grew faster than demand, pushing rents down. For landlords in Austin, this means being more flexible, offering concessions, and being aware that their unit might sit vacant rather than command premium rent. For renters, this is one of the better markets right now if they negotiate wisely. Next, let's consider Minneapolis, Minnesota, and the surrounding metro of St. Paul. In that region, rents dropped by around 6.3% from May 2024 to May 2025. Investopedia.com +1. Contributing factors: the cost of new construction rose substantially, permitting slowed. At the same time, the region had introduced housing affordability policy that affected market dynamics. The result, even without massive new build-outs, the market cooled and rents fell. For landlords, it means simply relying on the rents keep going up assumption is risky. For renters, it means more leverage when renewing or negotiating. Another noteworthy metro is Columbus, Ohio, where rent declines of around 3.5% were reported. Investopedia.com, although the decline is smaller compared to Austin or Minneapolis, it is still something. The cost of living in Columbus also remains below national average. For renters, this creates opportunity. For landlords, it signals that mid-sized markets are not immune to downward pressure. Also worth mentioning is Providence, Rhode Island. Here, a staggering headline figure appeared. Rents fell by roughly 19 to 22% year over year from 2513 to 2030, according to one source. House of Leon, London 1. If accurate, that is a dramatic drop in a relatively short period, and the policy environment is cited as a major factor. Easing development restrictions, streamlined permitting, transforming existing buildings. For landlords in such markets, it suggests that regulatory shifts can have outsized effects on rental pricing. For renters, it means markets, once considered expensive or overheated, may become more favorable. It is important to stress that not all US cities are seeing falling rents. Many markets still have rising rents or stable ones, especially in places with constrained supply, strong growth fundamentals, or limited new construction. The collapse trend is more pronounced in markets where supply surged, demand softened, or policy changed substantially. So this is not a universal rent crash story, but a selective one. Now, let us explore deeper implications and themes. From the landlord's view, if you own rental property in one of these markets experiencing a downturn or correction, you may notice longer vacancy periods, increased concession offerings, free month, lower rent, upgraded amenities, pressure on renewal rates, and the likelihood of tenants being more selective. Operating costs remain a wild card. You might still face high property tax increases, insurance cost spikes, maintenance backlog, and now you can't simply increase rent automatically every year and assume tenants will pay. Thus, property owners need to adapt, focus on retaining good tenants, invest in building quality and amenities, possibly reposition the property to a slightly different market segment, for example, offering shorter-term leases, flexible terms, furnished options, or even consider selling if the yield is slipping and the forecast is weak. From the renter's perspective, this environment is cautiously optimistic. You're in a stronger negotiating position than you were perhaps 2 years ago. You might find offers that include first month free, utilities included, waivers of pet fees, or the landlord willing to negotiate lease terms. You should still do your homework, check comparable unit rents in the same building or same block, ask for any incentives, and don't automate lease renewal at same rate. Also evaluate your cost of living broadly. Just because rent is falling in your city does not mean other costs, utilities, insurance, taxes are falling at the same rate. From a macroeconomic and policy lens, this rent drop trend serves as something of a correction after the sharp spikes of the pandemic era. It suggests that in certain cities the growth was unsustainable, driven by remote work relocations, low interest rates, and supply constraints. And now the pendulum is swinging back. It also raises questions about housing policy and planning. Cities that allowed more housing supply, especially multifamily units, and loosened zoning, appear to see earlier corrections in rent levels. For investors and policymakers alike, this signals that housing supply is a critical lever. Let's conclude with a practical walkthrough of how a typical video review of the top 10 collapsing rent cities might go. You'd open with the national context, median asking rents falling, units available rising, tenant leverage increasing, etc. Then you'd highlight each city, or 5 of them, with data, e.g. Austin, 8.8% drop, Minneapolis, 6.3% drop, Providence, 19% drop, Columbus, 3.5% drop. Then you'd explain why. In each case, oversupply from new construction, demand cooling, zoning, regulation shifts. Then you'd show what this means for landlords and renters. Then highlight cautionary notes. Just because rents drop does not mean the market is risk-free. Economic headwinds, job loss risks, property maintenance costs, local economic fundamentals matter. And finally, you'd provide actionable advice for both renters: negotiate, check comps, look for incentives, and for landlords, monitor vacancy, upgrade offering, consider alternative strategies. Keep it engaging with anecdotes. Mention that a landlord in Austin might now offer a free month or split utilities to fill the unit. Mention that a renter in Providence may find seriously lower asking rents than a year ago. Mention that property investors in cities like this are rethinking acquisitions or are shifting from buy and hold, expecting constant growth, to value add or reposition. In short, this is a story of supply catching up, demand shifting, and the structural dynamics of housing reacting to macro forces. Not a free-fall collapse everywhere, but meaningful adjustments in certain markets.